High-yield bonds are flashing warning signs that smart investors shouldn't ignore. Right now, junk bonds offer 7 to 8% yields, tempting returns in a low-yield world. But there's a catch. Credit spreads have tightened to near-historic lows while corporate leverage keeps climbing. This disconnect suggests markets aren't pricing in enough risk for what's coming. JP Morgan's research shows high-yield spreads currently sit at just 3.5 percentage points over treasuries, barely half the long-term average, despite debt levels reaching record highs. The setup looks eerily similar to 1989, just before the junk bond market collapsed. Back then, investors chased yield without properly assessing risk. Drexel Burnham Lambert, the king of junk bonds, went under when defaults spiked, freezing the high-yield market overnight. Investors were left holding worthless paper, a stark reminder of how quickly fortunes can turn. Today's conditions mirror that period. Easy money has fueled reckless borrowing, and now the bill is coming due. Corporate balance sheets tell the real story. The average high-yield issuer now carries debt at 4.5 times EBITDA, up from 3.5 times before the pandemic. Interest coverage ratios have dropped to 3.5 from 5.0 over the same period, showing companies have less cushion when earnings slow. Yet bond prices don't reflect this added risk. It's a double-edged sword. The allure of high returns masks the growing danger beneath the surface. Default rates are already creeping up. Moody's reports high-yield defaults reached 4.5% in early 2024, more than doubling from 2 years ago. If economic growth slows as expected, defaults could hit 5 to 6% by 2025, translating to $50 to $60 billion in bonds going bust. The pain won't be evenly spread. CCC-rated issuers face default risks above 15%, while BB-rated bonds might see just 2 to 3% defaults. For investors, this means the stakes are higher than ever. Liquidity is another concern. The high-yield market has shrunk by 25% since 2020 as many companies refinanced into loans. Fewer bonds outstanding mean bigger price swings when investors try to sell. Market makers now hold just 20% of the inventory they did pre-2020. This thin trading could turn orderly exits into fire sales when volatility spikes. The Fed's policy adds another layer of risk. Higher rates have pushed borrowing costs up dramatically. The average high-yield issuer now pays 8 to 9% interest versus 5 to 6% in 2021. Many companies took on floating-rate debt, so their payments keep rising with each Fed hike. This squeeze comes just as consumer spending shows signs of fatigue. Weaker sales plus higher interest equals trouble for marginal borrowers. Covenant quality has deteriorated too. Only 25% of new high-yield deals include strong investor protections today, down from 60% in 2010. Loose covenants give companies more leeway to take on additional debt or pay dividends that weaken their credit profile. When defaults happen, recovery rates will likely be lower without these safeguards. The maturity wall looms large. Over $500 billion in high-yield debt comes due between 2024 to 2026. Refinancing at today's rates could double interest costs for some issuers. Many companies simply won't be able to afford it. This is why credit analysts are watching 2025 so closely. That's when the refinancing wave peaks. JP Morgan's fixed income team recommends being extremely selective in this environment. They suggest focusing on BB-rated bonds from companies with strong cash flows and manageable debt loads. Their analysts highlight healthcare and energy sectors as relatively safer plays, given their stable revenues. Telecom and retail bonds, on the other hand, look riskier due to competitive pressures. The key takeaway? Quality matters more than yield when the credit cycle turns. And with economic clouds gathering, that turn could come sooner than many investors think. The municipal bond safe haven. Municipal bonds might be the closest thing to a safe haven in today's bond market mess. Imagine this, a retiree looking to protect their hard-earned savings during uncertain times. Munis offer tax-free yields around 3.5%. For someone in the top tax bracket, that's like earning 6% on a taxable bond. This tax advantage is a game changer. For someone in the 37% federal bracket, a 3.5% muni yield equals a 5.55% taxable yield. Add state taxes, and the equivalent yield jumps even higher. California munis, for example, offer tax-free income at both federal and state levels. a huge deal for high earners in expensive states. This tax break becomes even more valuable if rates rise further. And here's why it matters. State governments are in their best financial shape in decades. Rainy day funds are at record levels, and tax revenues have been strong. State and local governments have built up $136 billion in reserves, 50% more than before the pandemic. This cushion matters when economic storms hit. But not all states are equally prepared. Texas has enough reserves to run for 90 days, while Illinois can only cover 15 days. These differences highlight why location matters when picking munis. But before you jump in, there's a catch. Not all munis are created equal. Remember Detroit's bankruptcy in 2013 or Puerto Rico's debt crisis? These cases show that even tax-free bonds can blow up if you're not careful. The key is knowing where to look and what to avoid. Vanguard's municipal bond team recommends essential service revenue bonds, things like water systems, toll roads, and airports. These services generate steady cash flow regardless of the economy. General obligation bonds, which rely on a government's promise to pay, are riskier. If tax revenues drop, those payments could get squeezed. Pension liabilities remain a major risk. Some cities have promised more than they can deliver. Chicago's pension funding ratio sits at just 45%, and Los Angeles faces $10 billion in unfunded liabilities. When pensions eat up more tax dollars, there's less left for bond payments. That's why revenue bonds, insulated from these pension issues, are often the safer choice. Default rates show that munis are generally safe. Over the past 40 years, the 10-year cumulative default rate for investment-grade munis is just 0.1%, compared to 2.25% for corporate bonds. Even during the 2008 crisis, muni defaults stayed low. Most defaults were concentrated in risky sectors like nursing homes and speculative projects. Stick to essential services, and your risk drops dramatically. Liquidity has improved since the 2020 panic. Back then, muni markets froze and prices plunged. Today, trading volumes are healthier, and ETFs have made it easier to buy and sell. Still, individual bonds often trade infrequently, which is why many investors use mutual funds or ETFs for instant diversification and daily liquidity. Interest rate risk remains a concern. Like all bonds, munis lose value when rates rise. Vanguard suggests a barbell approach, mixing short-term munis for stability with some longer bonds for yield. This balances risk while keeping tax-free income flowing. The supply-demand picture also looks favorable. Muni issuance has dropped 20% from 2020 peaks as many governments built up cash reserves. At the same time, demand remains strong from high-net-worth investors seeking tax shelters. This imbalance could support prices even if broader bond markets weaken. For families looking to protect their savings, municipal bonds offer a rare combination of safety, tax advantages, and steady income.